It's time now for Muni Moment. Coming off the back of those Fed meeting minutes, of course, talking a lot about some of the rising rates, some inflationary concerns, of course, still being top of mind. For more on the impact, of course, of what that means for state and local government debt, I'm pleased to welcome Chris Brigati, Managing Director of Municipal Investments for Valley Bank. And I want to talk about those meeting minutes because there were zero mentions of recession. I'm stealing this data from BMO Capital Markets, Ian Leon, who is a friend of this program, but 90 mentions of inflation. What is that telling you about the path forward for rates and, of course, your muni bonds?
Sure. I mean, generally, thanks for having me, of course. Generally speaking, when we're talking about the inflation impacts upon the market, it's going to lead to higher rates. And the fact that the impetus and the real reason they spoke about it so much was to really put their best foot forward to show that they're really trying to be proactive, I think, was really impactful and is really going to drive the market. That being said, interest rates go higher. Munis will go along with that. We're really following the longer-term rate picture as well.
It's interesting that we have a chart in the last 2 years showing that munis actually haven't underperformed corporates. And I think in the last 2 years or so, there's a little bit of some defensive outperformance there. How much longer do you expect that to continue?
You know, I think it's going to last a little bit longer this year especially, and the reason being the supply-demand picture is really helpful towards munis. The supply is kind of limited, and demand remains strong. People want that tax-free income. They want to do what they can to be defensive in their portfolios, and the fact that municipals have kind of outperformed thus far kind of might be a little bit of a self-fulfilling prophecy and allow them to continue to be present in the space and buying the debt where they can.
We have great charts showing munis as a percent of treasuries. We talk about that as the muni treasury ratio. When it's above 100, you see a lot of crossover buyers. But now that treasuries are getting 3.5%, are those crossover buyers flocking to more full faith and credit and not so much in the muni market?
They did for a brief period of time. Back in May, we were over 100% in 10 years and 30 years as well. Prior to that, last year, it was well below 65% in 10 years for much of the year. And so that really leads to a little bit of a challenge for the market. Right now, it's at about 91, 92%, which is really the long-term average. So it's just kind of fair value right now. It's not really calling outside investors to come into the space as much as you would think.
I was reading a report from, I think, Fitch or one of the rating companies who was talking a lot about in these inflationary environments, how you're thinking about airports, some of the travel sort of classic reopening sectors. How do you think about that when it comes to credit quality for airports, toll roads, bridges, et cetera?
You know, I lump them in also with destination locations. Think of Las Vegas, think of where people want to go on vacation, et cetera. And convention centers are really heavily impacted by those sort of impacts. And what really that's going to do is drive people away from it, which drives revenue away, which creates a little bit of a challenge for them to kind of maintain their credit ratings in the long run.
How are they positioned, though, if we're thinking, I know that the Fed didn't mention recession, but if that's sort of in the next year or two in the zeitgeist, if they're already facing some pressure from inflation, how then do they shore up those budgets to prepare for what could be a recession?
A lot of it comes down to how they manage their short-term and near-term budgets. Personnel, wages, you know, those are higher, so they're dropping personnel, they're cutting back. I was recently on vacation, and we had room service every other day. Like those little things, you know, are really helping them maintain those revenues at revenue ratios, rather, at a relatively good level. But it's really a difficult environment for them.
Talk to me about, sort of in the face of rising rates, how you're thinking about duration. I know within the corporate sector, you know, maybe there's duration in investment grade, but maybe high yield has that shorter modified duration, so you get that defensiveness built in. How do you think about that in munis?
You think of it in a couple of ways. One is the structure of the bonds, whether it's a higher coupon or a lower coupon debt. And we're really finding some value and opportunity to, one, weather the storm of higher rates in higher coupon bonds. 5%, 4% coupons. When you're looking at 3% handles, which were really hammered in the past 6 months, you've got to be very careful of that. And the second thing is structure in terms of calls. Really managing that duration by having a 5% coupon with a 3, 4, 5-year call, you're really kind of setting some ballast in the portfolio, and that really helps investors.
Final question here. If you had to pick one, duration or credit?
I always have to go credit. I'm concerned about credit in the long run because that can get more difficult. So you really got to dig into the weeds and understand that, whether it's a GO or a REV, where are those cash flows coming from, how are they managing their income and their revenue stream, credit can go downhill really fast.